We have seen really companies being supported by not only fiscal action, but also monetary action. What are you seeing in the months ahead?
Yeah, I think, and we've discussed with Bloomberg before, that there's been a little sort of blunt style of policy in the first phase. And we think as we move forward, whether it be a fiscal authority or a monetary authority, the nature of policy will be much more targeted going forward. That applies to companies, applies to consumers, it applies to sort of broader households in particular. So I think that's the change that we're anticipating, and we don't think it's that far away.
Yeah, we have already seen those bankruptcies even rising in Japan. So where do you see investment opportunities, or how do you really defend yourself? How do you stay defensive in this environment?
Well, there's obviously a big cohort or a broad cohort of beneficiaries. So whether it be in companies that have been exposed in a positive way, so utilities, defence, telecom, cable, obviously very importantly healthcare, pharmaceuticals, etc., and technology. So there's a whole very large cohort of companies that are actually benefiting from the pandemic, whereas there's some others where we're a little cautious. So clearly the retailers, the traditional old school retailers, some parts of the energy complex that are very susceptible to weak oil prices or weak gas prices. So it's a matter of being selective, and then also acknowledging that in order for economies to recover, there needs to be key sectors that are protected. So whether that be in Australia's case, things like tourism, education will be those areas that are provided with ongoing government support rather than just temporary support.
Robert, as we continue to see earlier today, some of the spreads on the riskiest of US junk bonds fall below distress level, how much, I guess, dislocation or masking of the real risks is going on in this market because of these unprecedented policies?
Well, again, it's one of these issues where if we find that there's a reasonably fast exit from the health issues that we're all grappling with, then the majority of these companies will be survivors, and I think that's what the markets are hoping for. We're a little bit more cautious, though. We were very cautious going into the crisis, thinking that high-yield markets were already fully priced. We thought bondholder protection was very weak. So we've been pretty selective in terms of our holdings in high yield. We're much more focused on structured credit markets where bondholders get legitimate security or structural benefits. So we're already cautious, and we think that moving forward, if we're correct and this policy support becomes much more targeted, then there will be an increase in defaults. Now, all of that said, we're quite active at the moment in the primary market because the new deals that are coming provide much stronger bondholder protection. In some cases, they provide actual security. So we think it's that other cohort of outstanding deals that were done over the previous few years that are much more vulnerable than the current production.
So does the 60-40 portfolio still hold during these times? Do you just have to look harder within that 40?
Yeah, 60-40 I don't know if that's the right number or not. It's a great question. We do think bonds still have an important role to play, but it's also a matter of assessing the backdrop before you decide on where to invest in the bond market. So we have very clear guidance that central bank policy rates will remain at their lows, somewhere around where they are now, for potentially 2 or 3 more years. So given that backdrop, and given the fact that the very high quality part of the corporate sector, as I mentioned before, the structured credit sector, many of those companies have already termed out their debt. They've already made some very harsh decisions in terms of making sure their businesses are reliable and sustainable. So moving out of that very low rates in terms of government bonds and into the highest quality part of the corporate sector, we think is probably the best way to build the majority of that. If you're doing 60-40, that's the place to start when you're building that 40.